Imagine a single number that shapes the cost of money worldwide. It's not a rate set in a boardroom. It's determined by countless trades in the bond market. Yes, we're talking about the yield on the 10-year US Treasury bond. This yield influences every mortgage, every corporate loan, and impacts global debt markets. Today, this number is causing confusion and concern among investors. Recently, geopolitical tensions have led to dramatic changes in bond yields. Within weeks, the yield swung from below 4% to over 4.4%. This fluctuation makes a big difference for families determining affordability for their mortgages. Every tiny percentage affects monthly payments. So, what's behind these changes? The answer lies in inflation fears, a real challenge for economists and markets alike. Typically, during crises, investors flock to safe investments like US Treasuries. They expect bond yields to drop as demand increases. But that didn't happen this time. When the conflict in Iran began, instead of falling, the bond yield rose sharply. Why? The closure of the Strait of Hormuz led to skyrocketing oil prices. An energy shock like this doesn't just hint at future growth concerns, it raises inflation fears significantly. When inflation worries arise, bond investors demand higher yields to protect their purchasing power. So, this time, safety was found in the US dollar instead of US bonds. Bond markets are now facing complex pressures, the possibility of stagflation. Stagflation combines stagnant economic growth with high inflation. This is a difficult situation for policymakers to navigate. In standard recessions, central banks can lower rates to stimulate growth or raise them to combat inflation. Stagflation presents a dilemma, forcing central banks to choose between two painful options. Traders are betting that current oil price rises will lead to persistent inflation. Consequently, they push yields higher. If they think these energy price hikes will hurt economic demand, yields can drop. This tension has left yields fluctuating sharply with every piece of news from the conflict. The impact isn't just felt in the US. Countries globally experience varying effects based on their energy dependencies. For instance, British bonds have surged due to high reliance on energy imports. Germany's yields have risen as it grapples with supply chain issues post-Russian gas crisis. Interestingly, Japan's bond market has faced pressure too, despite years of battling deflation. Canada, however, has remained stable thanks to significant domestic energy production. As bond market volatility continues, how should investors respond? Major players like PIMCO are taking a cautious yet balanced approach, ready to adjust positions as opportunities arise. The lessons of the past guide today's strategies. Many recall the stagflation era of the 1970s, where inflation pressures altered policy responses for years. Investors now ponder whether to expect a rapid resolution to the current crisis or a longer-term challenge. In conclusion, the 10-year Treasury yield is shaped by sentiment, data, and geopolitical uncertainty. Investors currently hold two competing scenarios. 1. A quick resolution leads to lower yields. The other, prolonged conflict leads to higher yields driven by inflation concerns. Bond markets remain in flux, uncertain of the future. Each update from global leaders subtly shifts rates higher or lower, impacting borrowing for millions worldwide. Keep an eye on this critical number. It could signal the financial future of economies globally, making the ongoing events in that narrow strait crucial to watch. Remember, bond yields don't predict the future, they shape our financial landscape based on what may come next.